Today, we're diving into a crucial yet often misunderstood metric, the PE ratio. Stay tuned to discover why this number is a game changer in your investment strategy. We're breaking down one of the most talked about metrics in the investment world, the PE ratio. It's a figure that pops up everywhere from analyst reports to financial news, but what does it truly reveal about a stock? Is it a magic number that unlocks the secrets of smart investing, or is there more to the story? Join me as we delve into the heart of stock valuation, deciphering the PE ratio, understanding its nuances, and discovering how it fits into the bigger picture of your investment decisions. If you're new here, don't forget to hit that subscribe button and ring the bell so you never miss an update. Let's get started. Are you ready to turbocharge your investing journey? Weeble's got your back. Click the link in the description, deposit $100, and boom, up to 12 free stocks are yours. But why stop there? With Moomoo, grab 16 more free stocks. Keep them, sell them, profit from them. It's free money waiting for you. Don't blink, don't wait. Grab your free stocks today. Let's make investing exciting. Let's unravel the mystery behind the PE ratio, a key metric in the investor's toolkit. The price to earnings ratio, commonly known as the PE, is like a financial magnifying glass. It's calculated by dividing a company's current stock price by its earnings per share, commonly called the EPS. Think of it as a price tag for $1 of a company's earnings. If a stock is trading at $50 and the company's EPS is $5, the PE ratio is 10. This means investors are willing to pay $10 for every $1 of earnings. Simple, right? But here's where it gets interesting. The PE ratio offers a snapshot of what the market is willing to pay for a stock relative to its earnings. It's a quick way to check if a stock is overvalued or undervalued compared to its peers or the market average. Higher PEs suggest higher expectations of future growth, while a lower PE might indicate a potential bargain. But it's more than just a number. The context is king. The same PE ratio can signal different things in different industries or economic climates. In the world of investing, the PE ratio isn't just a number, it's a story. It reflects investor sentiment, market trends, and industry benchmarks. For instance, tech companies often have higher PE ratios due to high growth expectations. In contrast, utility companies might have lower PE ratios, reflecting stable but slower growth. But here's a pro tip. The PE ratio also acts as a reality check. It can help temper overenthusiasm for a stock that's the talk of the town but doesn't have the earnings to back it up. However, it's not a crystal ball. It doesn't reveal everything about a company's financial health or future performance. That's why savvy investors use it as a starting point, not the end-all be-all. They combine it with other financial ratios and a thorough analysis of companies' fundamentals. In essence, understanding the PE ratio is about mastering the art of context, comparison, and caution in the dynamic world of stock investing. Let's talk about the pros and cons of the PE ratio. When you dive into the complex world of the PE ratio, you'll see it's a tool of contrasts. On one hand, the PE ratio is incredibly user-friendly, providing a quick, straightforward measure to compare the value of companies. It's a favorite among investors for its simplicity, a single number that condenses a wealth of information about a stock's market value relative to its earnings. When used wisely, it's like a compass guiding investors through the maze of stock valuation, offering a baseline for comparing stocks within the same industry. A high PE might indicate a stock with expectations of strong future growth, often seen in tech startups. On the flip side, a low PE might reveal a potentially undervalued stock, perhaps an overlooked gem in more traditional sectors. However, the PE ratio isn't without its pitfalls. This seemingly simple metric can be deceptive. It's a snapshot, yes, but one that doesn't always tell the full story. Earnings, the denominator in this ratio, are subject to fluctuation and can be manipulated through accounting practices, affecting the PE ratio. Moreover, the ratio varies widely across different industries, making cross-sector comparisons very tricky. A high PE might not always spell overvaluation, nor does a low PE always signal a bargain. The ratio also ignores crucial factors like a company's debt, cash flow, and future growth potential. It's like judging a book by its cover without reading the pages within. Investors relying solely on PE might miss out on key financial nuances, leading to oversimplified and sometimes erroneous investment decisions. Thus, while the PE ratio is a valuable tool in an investor's arsenal, it demands a careful, nuanced approach, complemented by other financial analysis and market insights. Let's simplify the PE ratio's limitations. Think of it as a snapshot that doesn't always tell the whole story. A high PE ratio can suggest that investors expect big things from a company, like strong future earnings, especially in fast-growing sectors, but sometimes a high PE ratio might just be over-optimism, not based on solid financials. On the other hand, a low PE ratio might seem like a bargain, but it could also signal a company facing challenges or an industry in decline. What's more, the PE ratio is based on earnings, which can vary for reasons like market trends or accounting changes. This variation means the PE ratio can be misleading if used on its own. It's important to remember that the PE ratio doesn't consider other vital factors like how much debt a company has or how much cash it generates. These elements are crucial for understanding a company's overall health and potential. So while the PE ratio is a useful quick check, it's best used alongside other financial measures for a fuller picture. Are high PE ratios ever a good thing? In the intriguing world of high PE ratios, we find companies that are the market's darlings, often tech giants or innovative startups. These firms boast high PE ratios because investors might see a bright, profitable future for them. They're willing to pay more today for earnings that are expected to soar tomorrow. This is where growth takes center stage. Companies with rapid revenue growth, like those pioneering new technologies or tapping into fresh markets, represent potential. Investors anticipate that these companies' earnings will grow faster than their current rate, justifying the premium price of their stocks right now. It's a bet on the future, driven by visions of market dominance, revolutionary products, or groundbreaking services. However, this high-reward scenario doesn't come without risks. A high PE ratio places enormous expectations on a company to deliver substantial growth. Any signs of slowing down, whether in innovation, market expansion, or revenue, can lead to significant stock price corrections. Moreover, these high PE companies are more susceptible to market volatility. Investors are quick to react to any news that might impact the company's projected growth trajectory, leading to more pronounced stock price fluctuations. Therefore, investing in high PE stocks demands not only an understanding of the company's growth potential, but also a readiness to navigate the choppy waters of market sentiment and speculation. It's a delicate balance of foresight, strategy, and risk management. Stepping beyond the PE ratio reveals a landscape rich with other vital financial indicators crucial for better stock analysis. Savvy investors often turn to the PEG ratio, which adjusts the PE for expected earnings growth, offering a more dynamic perspective. This ratio can level the playing field, providing a clearer comparison between high-growth tech companies and more stable traditional industries. Additionally, metrics like the debt-to-equity ratio shed light on a company's financial leverage, indicating how much of its operation is financed by debt versus shareholder equity. A high net debt to equity ratio might signal financial stress or aggressive growth strategy, while a low ratio could suggest conservative management. Another key aspect is free cash flow, the lifeblood of any business. This metric reflects the actual cash a company generates after covering its operational costs and capital expenditures. It's a potent indicator of a company's ability to invest in growth, reduce their debt, and return value to shareholders. Remember, the stock market is a complex ecosystem. Relying on a single metric like the PE ratio can lead to an incomplete and sometimes distorted view of a stock's true value. It's like trying to understand a painting by looking at just one corner. A thorough stock evaluation should combine various financial ratios with an in-depth analysis of company fundamentals, market trends, and economic indicators. This approach equips investors with a comprehensive view, enabling informed strategic investment decisions. And now for the summary. In the journey of stock market investing, understanding the PE ratio is just the beginning. It's a tool that opens the door to deeper insights, but must be used with caution and context. Remember, high PE ratios can indicate growth potential, but also come with higher risks and expectations. Low PE ratios might point to undervalued stocks, yet they could also signal underlying problems. The key is not to get fixated on this single metric. Instead, blend it with other financial indicators like the PEG ratio, debt to equity ratio, and free cash flow to get a comprehensive view of a company's financial health and growth prospects. This multidimensional analysis helps in making informed investment choices, steering clear of market noise and speculative traps. As you apply these insights to your investment strategy, remember that the stock market is dynamic and complex. It requires continuous learning, adaptability, and a keen sense of judgment. By combining various analytical tools with an understanding of market trends and economic indicators, you equip yourself with a powerful compass to navigate the stock market's twists and turns. This approach not only enhances your investment decisions, but also enriches your journey in the fascinating world of stock investing. So keep exploring, stay informed, and invest wisely. Thank you for joining me on this deep dive into stock valuation. Don't forget to like, share, and subscribe for more insights into smart investing. Until next time, happy investing. Peace.